Imagine waking up tomorrow to headlines saying one of America's closest allies just pulled more than $1 trillion out of the U.S. financial system. Bond markets are shaking, currencies are sliding, and investors everywhere are asking the same terrifying question: is this the moment everything finally breaks? This isn't a movie plot or a doomsday fantasy. It's a real fear quietly spreading through global markets right now, driven by one simple idea that sounds technical but hits at the heart of the entire system. Japan, the world's largest foreign holder of U.S. debt, may be heading for an exit so large it could change the financial world as we know it. To understand why the phrase $1.2 trillion exit is so explosive, we need to slow down and unpack what that number really represents. Japan has spent decades buying U.S. Treasury bonds, the IOUs issued by the U.S. government to fund its spending. These bonds are considered the backbone of the global financial system. Banks use them as collateral, central banks store them as reserves, and investors treat them as the safest place to park money during uncertainty. For years, Japan has been at the top of that list, holding roughly $1.10 to $1.2 trillion in treasuries, depending on the month. That makes Japan not just a participant, but a pillar of the U.S. debt market. When a pillar even hints at moving, the entire structure starts to creak. Now here's where the tension begins. Japan isn't selling treasuries because it wants to attack the U.S. or trigger a crash. It's under pressure at home. The Japanese yen has been weakening sharply against the U.S. dollar, falling to levels not seen in decades. A weak yen makes imports like energy and food more expensive, fueling inflation in a country that spent years fighting deflation. To defend its currency, Japan's government and central bank need dollars. And where do those dollars come from? From selling dollar-denominated assets, primarily U.S. treasuries. This is not theory. Japan has already intervened in currency markets before, selling U.S. bonds to buy yen, and official data shows periodic reductions in its treasury holdings during moments of intense yen pressure. Think of it like a homeowner who owns a massive savings account but suddenly faces rising bills and falling income. To survive, they start selling assets. At first, it's manageable, but if the pressure doesn't ease, the selling accelerates. Markets don't panic because of one sale, they panic because of the possibility of sustained selling. If Japan even gradually begins unloading hundreds of billions of dollars in treasuries, yields rise. When yields rise, bond prices fall. When bond prices fall, everything priced off those bonds, from mortgages to corporate loans to government borrowing costs, becomes more expensive. This is why investors are so nervous about the idea of a final crash. Us. Treasuries are not just another asset class. They are the reference point for global finance. The 10-year Treasury yield influences how much you pay for a home loan. The short-term Treasury bill rate influences savings accounts and money market funds. When those rates spike quickly, liquidity dries up. We saw a preview of this in 2022, when rapid rate hikes caused bond markets to suffer historic losses and even broke parts of the UK pension system. That was with far smaller disruptions than a coordinated or forced exit by a major holder like Japan. At the same time, the U.S. itself is issuing massive amounts of new debt. Trillion-dollar deficits are no longer an emergency measure, they are routine. That means the Treasury must constantly find buyers for new bonds while also refinancing old ones. If a major buyer steps back or turns into a seller, supply overwhelms demand, prices drop, yields jump, and suddenly the cost of running the U.S. government explodes. This is where fear spreads from bond traders to equity investors, then to businesses, then to households. So where do precious metals enter the story? Gold and silver have always been financial thermometers. They don't generate cash flow, but they reflect trust, or the lack of it. When confidence in paper assets weakens, metals tend to shine. Gold is often called a hedge against currency debasement because it can't be printed. Silver, while more volatile, has the dual role of being both a monetary metal and an industrial one, tying it to economic cycles and technological demand. When investors worry that bond markets are unstable or that central banks will respond with more money creation, they start looking for assets outside the system. That's why even rumors of large-scale treasury selling often coincide with rising interest in gold, silver, and other hard assets. Historically, these moments follow a pattern. In the late 1960s and early 1970s, heavy foreign pressure on U.S. gold reserves and dollars led to the collapse of the Bretton Woods system. In 2008, cracks in mortgage-backed securities triggered a global financial crisis that only stabilized after unprecedented central bank intervention. In 2020, a dash for cash briefly broke the Treasury market itself, forcing the Federal Reserve to step in as buyer of last resort. Each time, the crisis wasn't just about one asset. It was about trust, liquidity, and the realization that what everyone assumed was safe suddenly wasn't behaving that way anymore. Right now, Japan sits at the center of a delicate balancing act. Defend the yen too aggressively, and it risks destabilizing global bond markets. Don't defend it enough, and domestic inflation and political pressure rise. Meanwhile, the U.S. Federal Reserve is trying to fight inflation without blowing up the debt market, and investors are trying to decide whether today's yields are an opportunity or a trap. This is why the phrase $1.2 trillion exit resonates so deeply. Its symbol? Eyes is a point where structural pressures collide, and where small policy decisions can have massive unintended consequences. The real danger isn't that Japan dumps all its treasuries overnight. That's unlikely. The danger is a slow, persistent shift that changes market psychology. Once investors believe a major holder is on a one-way path to selling, they front-run the move. Prices fall faster, volatility rises, and confidence erodes. That's how financial earthquakes begin, not with a single explosion, but with a series of tremors that people ignore until the ground finally gives way. Because once that confidence starts to crack, markets don't wait for official announcements or polite explanations from central banks. They move on instinct, fear, and self-preservation, and that is exactly what makes Japan's situation so dangerous for everyone else watching from the sidelines. Investors around the world are trying to answer a deceptively simple question: who replaces Japan as the buyer of last resort if it steps back, even partially? For decades, the answer was easy. Foreign central banks recycled trade surpluses into U.S. Treasuries. It was almost automatic. Export goods earn dollars, buy Treasuries, stabilize currencies, repeat. That loop helped keep us borrowing costs low and global trade flowing smoothly. But that loop is breaking down in slow motion, and Japan's potential exit is the clearest signal yet. China, once the second largest holder of U.S. debt, has already been reducing its treasury exposure for years, redirecting reserves into gold and other assets while dealing with its own domestic financial strains. Europe faces fiscal pressures and aging populations that limit its ability to absorb massive amounts of U.S. debt. Emerging markets don't have the balance sheets to step in at scale. That leaves a growing gap between the amount of debt the U.S. needs to sell and the natural demand from traditional foreign buyers. In theory, higher yields should attract new buyers. In practice, sharply rising yields can destabilize markets so quickly that buyers hesitate, waiting for clarity that never seems to arrive. This is where the feedback loop becomes dangerous. As yields rise, bond prices fall. Banks holding those bonds see losses on their balance sheets. Pension funds and insurance companies, which rely on stable bond values to meet long-term obligations, face stress. We saw this vividly when Silicon Valley Bank collapsed after rapid rate hikes crushed the value of its bond portfolio. That was a single institution. Now imagine a similar dynamic playing out across the system as a whole, driven not by policy tightening alone, but by structural selling pressure from a major foreign holder like Japan. At the same time, the U.S. government's interest expense is ballooning. With debt surpassing $34 trillion and a large portion needing refinancing at higher rates, every percentage point increase in yields translates into hundreds of billions of dollars in additional interest costs over time. That money doesn't build roads, fund innovation, or support households. It goes straight to servicing past obligations. Investors know this, which is why they watch Treasury auctions so closely. Weak demand or higher than expected yields aren't just technical signals, they're warnings that the cost of maintaining the system is rising faster than the system itself can grow. So how do policymakers respond when faced with this kind of pressure? Historically, there are only a few options, and none of them are painless. They can allow yields to rise and risk recession, financial instability, and political backlash. They can cut spending or raise taxes, which is difficult in a polarized political environment, or they can step in through central bank intervention, effectively creating money to absorb excess debt and stabilize markets. That last option doesn't always look like outright money printing at first. It can come in the form of emergency liquidity facilities, balance sheet expansions, or subtle changes in policy language. But the end result is the same: more currency chasing the same amount of real value. This is where precious metals come back into focus, not as a speculative trade, but as a signal of trust. Gold doesn't default. It doesn't need a bailout. It doesn't rely on someone else's promise to pay. When investors see central banks boxed into corners, they start asking what happens if the solution to every crisis is more liquidity and more debt. Historically, gold performs best not just during inflation, but during periods of financial repression when interest rates fail to keep up with the real cost of living. Silver, meanwhile, often lags at first, then accelerates sharply when investors realize that monetary stress and industrial demand are colliding at the same time. Another layer of complexity comes from derivatives and leverage. The Treasury market isn't just about buying and holding bonds. It's deeply intertwined with futures, swaps, repos, and other instruments that rely on Treasuries as pristine collateral. When volatility spikes, margin requirements increase. When margin requirements increase, forced selling follows. This is how relatively contained issues turn into systemic events. Japan selling bonds to defend its currency could indirectly tighten financial conditions worldwide, even for players who have nothing to do with Japan or the yen. And yet, from Japan's perspective, the choice is brutal. Allow the yen to keep weakening, and domestic purchasing power erodes, squeezing households and businesses. Inflation, once considered almost impossible in Japan, becomes a political and social problem. Defend the yen too aggressively, and global markets feel the shockwaves. Japan's central bank has already spent years holding interest rates near zero, while others raised rates sharply, creating a massive interest rate differential that pressures the currency. Closing that gap risks crashing Japan's own bond market, which is even more indebted relative to GDP than the US. In other words, Japan isn't choosing between good and bad options, it's choosing between bad and worse. This is why analysts talk about a potential tipping point rather than a single event. The final crash narrative isn't about one dramatic announcement. It's about a gradual realization that the old assumptions no longer hold, that treasuries can always absorb unlimited supply, that foreign buyers will always step in, that central banks can fine-tune outcomes without unintended consequences. Each time one of these assumptions is challenged, risk premiums rise and investors demand greater compensation for uncertainty. You can see this uncertainty in market behavior already. Equity markets swing wildly on bond yield movements. Tech stocks, which rely on low discount rates for future earnings, become especially sensitive. Real estate slows as mortgage rates climb. Even currencies start to behave erratically as capital flows chase yield and safety at the same time. In this environment, the question isn't whether volatility will increase, it's whether the system can absorb it without something breaking. Japan's $1.2 trillion position looms over all of this like a shadow, not because Japan wants to pull the trigger, but because it might have to keep adjusting month after month, sale after sale, intervention after intervention. Each move sends a signal, each signal shifts expectations. And markets, once they sense a trend, rarely wait for confirmation. They move first and ask questions later, which brings us to the most important question of all. What happens if the selling doesn't stop? And what does that mean for investors trying to protect their wealth right now?